Have you ever wondered why financial markets, no matter how stable they seem, sometimes collapse suddenly? Why do economies appear strong one moment and then plunge into crisis the next? Imagine this. It's 2007. The housing market is booming. Banks are lending freely, and everyone feels unstoppable. And then, in 2008, Lehman Brothers collapses, triggering a global financial crisis that shakes economies worldwide. How does something like this happen? The answer lies in the insights of economist Hyman Minsky, whose financial instability hypothesis explains why stability itself can create instability. Before diving into Minsky's ideas, it's helpful to understand a simple concept: the business cycle. Economies naturally move through periods of expansion, when growth, investment, and employment rise, and contraction, when activity slows and recessions occur. During expansions, optimism grows, borrowing increases, and businesses invest heavily. During contractions, debts become harder to repay, spending slows, and financial stress emerges. Minsky's theory builds directly on these cycles to explain why periods of calm can sometimes lead to bubbles and crises. Minsky argued something counterintuitive. Stability breeds instability. When markets and economies appear calm for long periods, businesses, banks, and investors grow confident. They begin to take on more risk, assuming that nothing bad will happen. This increased risk-taking accumulates over time, creating fragility that eventually leads to financial crises. Think of it like walking on a frozen lake. When the ice feels solid, people walk farther and farther out. Eventually, the ice cracks and disaster strikes. At the heart of Minsky's theory are three types of financing behavior among borrowers: hedge, speculative, and Ponzi finance. Hedge finance is the safest. Borrowers can meet both interest and principal payments from current cash flows. It's like paying your rent from your salary without borrowing more. Low risk and sustainable. Speculative finance is riskier. Borrowers can pay interest, but must roll over or refinance the principal. Imagine taking a loan hoping a bonus or investment payoff will cover it. Manageable, but dependent on luck or market conditions. Ponzi finance is the riskiest. Borrowers cannot pay interest or principal from cash flows. They rely entirely on asset price appreciation to survive. Think of betting on lottery winnings to pay off your debts. A house of cards waiting to collapse. As the economy moves through periods of stability, borrowers shift from hedge to speculative to Ponzi financing. This creates a cycle of financial fragility, culminating in what Minsky called a Minsky Moment, a sudden collapse triggered by over-leverage and risky speculation. The 2008 global financial crisis is a clear example. During the early 2000s, U.S. housing prices rose nearly 50%, and many borrowers relied entirely on rising home values to repay their debts. When the bubble burst, it triggered a chain reaction across banks, investors, and households, illustrating Minsky's principle in action. Other examples include the 1929 Great Depression and Japan's 1980s real estate bubble. Minsky's ideas also align with an old proverb: hard times create strong men create good times create weak men, and weak men create hard times. During crises, people and institutions become cautious, disciplined, and resilient. These strong men foster stability and growth. But as good times persist, overconfidence and risk-taking grow, creating the conditions for the next crisis. Just like generations rise and fall, the financial system cycles between stability and fragility. What causes these risky shifts? Easy credit, low interest rates, financial innovation, and herd behavior all encourage speculation. Investors see rising asset prices and assume they will continue. Banks relax lending standards, and borrowers take on more debt. Over time, leverage increases, and the economy becomes vulnerable to shocks. One small disturbance can trigger a chain reaction, leading to a full-blown crisis. We can also relate this to everyday life. Imagine you are juggling three priorities: work, family, and health. You can focus on any two effectively, but trying to fully manage all three often leads to burnout or neglect in one area. Similarly, in financial systems, pursuing growth and optimism without caution can lead to instability, just as ignoring warning signs in your personal life can lead to stress and collapse. The first key takeaway from Minsky is clear. Periods of calm and stability can hide growing risks. Stability breeds instability, and overconfidence during prosperous times can transform a healthy economy into a fragile system, as we saw in the 2008 financial crisis. Policy implications from Minsky's hypothesis are profound. Regulators and central banks should recognize that stability can be deceptive. Counter-cyclical policies, careful monitoring of credit growth, and regulation of speculative activities are essential to prevent bubbles from growing unchecked. Minsky reminds us that financial crises are not random accidents. They are predictable patterns arising from human behavior and market incentives. In conclusion, the most important lesson is simple but powerful. Stability breeds instability, risk grows during calm periods, and financial systems are only as resilient as the behavior of the people within them. Just as the proverb reminds us, the cycles of human behavior and the economy are intertwined, and ignoring them can be costly. So next time the markets seem unstoppable, ask yourself, are we walking on solid ice, or are we already halfway out, unaware of the cracks below?